So please join me in a warm Yellow Jacket welcome for Mr. Dennis Lockhart.
Well, Nick, thank you very much for that introduction. A few days ago, someone contacted me from here at Georgia Tech, and they said, "What's the title of your talk?" Well, I hadn't given it a lot of thought, quite frankly, so I said, well, how about observations about working at and the work of and working at the Fed. And so that's what I'm going to talk about today. And it's a title that gives me a lot of scope to give you a bit of background, I think, and then talk about what the institution does and especially what I do as a Federal Reserve Bank president. I'd like to start with a quick tutorial on what your central bank is. I'm sure there are people in the room who aren't aware of this. This is going to cover some ground that I've actually covered in classes here in this room. Professor Gary Jones and Joel Cowan have combined their classes in recent years, and I give a lecture once a year for that class, which is sort of like Fed 101, what the central bank does. And I get paid with football tickets, so I'm signed up to go to the Virginia Tech game. Really sorry about the Virginia game because it looked to me like you're going to be undefeated by Virginia Tech, but in any event, I'll be there on that Thursday night, cashing in what I got paid for giving a lecture here in this room for students. The Federal Reserve, the Fed as it's called, is the central bank of the country, and its broad business is managing the money of the country, both in the literal sense of the distribution and management of currency, greenbacks that you might have in your wallet or in your purse, but more importantly, the broad supply of money, which is mostly electronic in our society, and managing the interest rates or the cost of that money. That's broadly what we do. We do a lot of other things, but that which is called monetary policy is a central responsibility of the Fed. All central banks have this responsibility, at least where there is a distinct currency for that particular country. The dollar actually acts as the currency in several countries that have dollarized, meaning that they have just given up on having their own currency and used the dollar. So in effect for them, the Federal Reserve is like their central bank in some respects, but we focus only, by statute, only on the domestic economy. We're the central bank of the United States, and it's the U.S. economy alone that we're concerned with. The structure of the Federal Reserve is that there is a Board of Governors in Washington, and that Board of Governors, fully staffed with governors, is 7 governors, and the chairman of the Board of Governors and the chairman of the Federal Reserve is Ben Bernanke. Those are politically appointed jobs, so currently President Obama would appoint them, nominate and appoint them, and the Senate would confirm them. So they are put in place through a political process. There's a substantial staff in Washington that does a variety of things in economic analysis, the help to the governors in preparing for monetary policy deliberations, and a big staff that deals with bank supervision, working with the reserve banks. So quite a substantial presence in Washington. Then there are 12 reserve banks with 12 different geographic districts. You here in Atlanta are in the 6th district, which is made up of Georgia, Alabama, Florida, about 3/4 of Tennessee, a little more than half of Mississippi, and half of Louisiana. Those rather strange borders were drawn in 1913. So the Federal Reserve as an institution will have a centennial coming up in 2013. And those borders must have made sense in 1913, but now we always have to explain that we share states and so forth. The 6th district, which is the district I oversee, is about 41 million people, all totaled, and about 13% of the gross domestic product of the United States. So it's a substantial part of the economy of the United States. Each of those 12 reserve banks is an independently chartered corporation with a board of directors. We are not, strictly speaking, government, although the Federal Reserve System should be considered as an independent agency within government, but the reserve banks are independently chartered corporations. So if you want to know who do I work for, I really work for the chair and the board of the Federal Reserve Bank of Atlanta. And those boards of the reserve banks are in effect working for nothing citizens reflecting different industries. We have 9 directors. Currently the chair of the Atlanta Bank is Carol Tomei, who is the chief financial officer of Home Depot. And we get a lot of economic input and intelligence from our boards. I mentioned the point of independence. I'm going to come back to that in a moment. It's a very important principle, particularly in the formulation of monetary policy. So just hold that thought, and I'll come back to that in a second. The principal monetary policy shaping body or setting body is the Federal Open Market Committee, in which there are fully staffed 19 participants, all 7 governors and 12 Reserve Bank presidents. At any given time, 12 of those 19 vote. I'm not voting this year, but come January, I vote. The voting really doesn't matter a great deal, let's just say it's not as important as it may appear. And this is the deliberative body, a very collegial and civil discussion of what policy should be, all aimed at just setting policy in the best interests of the country. The Federal Open Market Committee has 2 mandates that have been given to us by Congress. Those 2 mandates, it's called the dual mandate, are first price stability or low inflation, and the second is maximum employment, and essentially trying to manage the overall economy in such a way that you can get to full employment. Full employment is not 100% of people who want a job having a job, but it certainly is not 9.1%, which is what we have today. It's a lower number. And so we basically try to balance those 2 objectives. I guess the final thing I should mention in your quick tutorial on the Fed is that although we're independent within government in setting monetary policy, the Federal Reserve, the central bank, is the creature of Congress. So we have been chartered in a statutory way by Congress. And the chair, Ben Bernanke, in effect reports to Congress. Twice a year he goes to the Hill and gives a report on the state of monetary policy particularly. And our governors and occasionally a Reserve Bank president testify frequently on the Hill. So there is an ultimate reporting relationship, even though we are somewhat independent of and aloof of normal day-to-day politics in the country. I want to give a little background on what got me to the position of being a Reserve Bank president. My career I describe as eclectic and purposely so. I set out with some idea I wanted to do several things in life. I wanted to work overseas. I wanted to work in the business world, private sector. I wanted to, at some stage, teach. And I also wanted to have some public service experience. So those are sort of the broad goals. And I've been fortunate to more or less check those things off as I've gone along. I began my career with what is now Citigroup in New York for 1 week, and then Lebanon, followed by Riyadh, Saudi Arabia, Jeddah, Saudi Arabia, back to Lebanon, evacuated to Athens in the Civil War, some time in Greece, then to Tehran, Iran, where I left in the middle of the revolution. There's a sort of theme here of bad news following, and came here to Atlanta. And I was here in Atlanta heading corporate banking for what was then Citicorp for 8.5 years here in Atlanta. Then went on to another company. Actually, I spent one more year working on Latin American debt restructuring in New York, and then went to a smaller company where I was the president of the international part of the company, and we did small business finance in about 20 different countries, and did that for a number of years. Then, as Nick mentioned, a couple of years in a private equity firm, also working as the non-executive chair of another private equity group out of Washington that invests in sort of second-tier emerging markets, and got the opportunity to teach. So I went to Georgetown for 4 years, and along came the opportunity that I'd always wanted to do something in public service. So I joined the Fed in March of 2007. In March of 2007, to show you how much the world has changed in the last 4.5 years, the unemployment rate was about I believe, 4.5% or something close to that. And the federal funds rate, which is the policy rate that we use to set monetary policy, was about 5.5%. So those are round numbers, but now the federal funds rate is effectively zero and unemployment is 9.1%. So clearly a lot has changed. When I was a young international banker working in the Middle East, we would periodically have seminars on subjects like country risk evaluation and the evaluation or the decision process around country exposure. The way a large multinational bank operates is they set a number, a limit for how much corporate exposure you have in a particular country. And long before I ever had any inkling that I would join the Federal Reserve, I sat through several sessions in which they were teaching the more junior people how you think about exposure to a country. And I think some of what I learned, this is now almost 40 years ago, is relevant today. So let me kind of walk you through that thought process, which I think, as I said, I think is interesting and has relevance to today. Essentially, the senior people, most experienced people in the bank said, if you're going to go evaluate a country, you start by looking at the relative scale of the public sector and the private sector. And you look at the growth of the public sector relative to the private sector. If you see a country in which the public sector is growing, then you ask yourself the question, how is that being financed? Is it growing with deficit spending, for example? And if it is growing with deficit spending, it has to be financed. So how are they financing? Are they financing, is the government financing its deficit spending with domestic debt issuance or external debt issuance, where in effect the savings of foreigners are paying for the deficit spending, or some of it at least, of the government? And if the answer is that yes, there's deficit spending, and it's being, let's say, financed with the issuance of domestic debt, then the next question is the central bank creating money, printing money, and buying that debt? That's called monetization of the debt. And if the answer to that question is yes, then the next question is, does the central bank appear to be doing that under political pressure of some kind? In other words, is the central bank in effect the handmaiden of deficit spending government, and under pressure is monetizing the debt? And if the answer to all those questions was yes, what I was taught almost 40 years ago is don't increase your exposure to that country, and maybe you short the currency because you don't want to be long the currency of that country. I don't want to make too much of this analogy except to say that there are some interesting parallels that need to be thought about worldwide. I'm not just saying in the United States, worldwide. And those lessons I learned almost 40 years ago now. Central to that story is the point that central banks need to be independent of politics and make decisions effectively on their own in the best long-term interest of the economy that they're serving, and not be making decisions under political pressure. So the principle of central bank independence is a broadly, globally held central idea related to good governance of a country. And I think it's a very important principle here in the United States as well, particularly in this period in which the Federal Reserve and its activities are to some extent more politicized than they have been in the past. So this relates to monetary policy, and that's what I was talking about just a second ago. But the Fed does a number of other things. We are a central player in and have some oversight responsibility for the payments system. And I spend a fair amount of my time in some management deliberations around our activities here in Atlanta related to the payment system. The Atlanta Federal Reserve Bank has national responsibility for retail payments, meaning what you and I do, as opposed to wholesale payments that are done from corporations and governments, principally in large numbers. Retail payments tend to be smaller ticket numbers. So we have a management team here in Atlanta that oversees retail payments. What's that all about? It's about checks, but increasingly it's about electronic funds transfers, what are called ACH, which stands for Automated Clearinghouse. And electronic funds transfers, which is I'm sure what most of you use when you use your debit card, is the principal way now that retail payments are made in the country, and growing, not growing terribly rapidly, but growing, whereas the use of the old check is declining very rapidly. I'll talk about that a little bit more in a second. We also have a big function here in Atlanta and a couple of other cities across the Southeast in bank supervision. In other words, we are a regulator. We're part of the regulatory system. The bank regulatory system is a little bit complex because there are some other parties involved, the Federal Deposit Insurance Corporation, FDIC, the Office of Controller of the Currency is responsible for nationally chartered banks. But we share with those agencies and also the new Consumer Financial Protection Agency, our bureau, we share responsibility for oversight of the banking system. And because of recent legislation, the Federal Reserve has sort of broad responsibility for financial stability and has oversight over what are called systemically important institutions. So we do that as well. Here in Atlanta, I have working with me, round numbers, 350 bank examiners whose job it is to go and basically examine banks and determine their solvency. We also have a major research function, essentially almost like an academic department within the Federal Reserve with credentialed, mostly PhD economists who support me in my developing my opinions related to monetary policy, but also do their own research and follow their own instincts as to what are the important questions, and we give them a certain amount of freedom to pursue their own instincts, and they're part of a larger, call it academic world of PhD academic economists who are really important to evaluating policy and helping the Fed in many respects make its decisions. We have a community development function, not big, but we do some of that as well, and we also are active in economic and financial literacy education where we have people who put on workshops for high school teachers who then include in their curriculum some economic and particularly financial literacy in recent years has become more important material in their curriculum. So those are the activities. Now, what I thought I might do to make this come alive for you a little bit and to be perhaps a little more interesting than just sort of plodding through the detail of what the Fed does is to sort of take you along for the last 48 professional hours of my week to give you a sense of the breadth of things that someone in my position has to think about and deal with, and some of the insights I've gained from the interaction I've had with various people over the last couple of days. Now, I'm going to be a little liberal with 48 hours because I'm going to start Monday at noon and I'm going to go through tonight's dinner, but the point of this is to just give you a flavor of sort of what are the range of things that I have to deal with, and also use that as a vehicle for making some substantive comments on the issues of the day that we are engaged with at the Fed. So let me start with noon Monday. Had a lunch here at the Atlanta Fed with 6 mid-sized bank CEOs who were invited from all over the Southeast. These are largely pretty successful banks, and they came in. You know, we're their regulator. That makes them nervous, but we said, look, this is for real dialogue, not for either attribution or retribution. Say what you want to say. Tell us what you're thinking, because we just want feedback and we want to hear from you how things are going in your banks and in your respective markets. So the things we talked about were first the burden of regulatory compliance. The Dodd-Frank Act, which was passed last year and which we're in the process of implementing, about 1,800 pages, I believe, of federal legislation, involves quite a substantial change in the banking regulatory system of the country. We have been charged to carry out the law of the land, obviously, and to implement that act and to make a lot of rules. And we wanted to hear from bankers. And these are banks of, I said, medium size. They're not terribly small. They're also not the giant banks even in this region, but they're good-sized banks. Hear what they thought about life under the Dodd-Frank Act and under the kind of the new world of bank supervision and regulation. What we heard is that they've had to beef up their compliance staff, and that they feel a distinct difference now in terms of the senior management attention and also the cost and staffing required to comply with regulations. We also talked about loan demand. As you are, I'm sure, aware, the banks get blamed for the lack of lending or for not lending enough. So we asked them about how they saw the world. And the world from the perspective of a banker is not enough people who qualify under current economic circumstances and after the financial crisis and recession, who qualify are asking for a loan. So from their perspective, there is a weakness of loan demand. We asked them their feelings about the economy. Obviously, these are regional bankers for the most part. Some have national businesses. And the general sense we got was not getting worse, but not getting better very fast either. A sort of slow growth economy. That's really the picture I have. But it was confirmed by the conversation with these bankers. I also talked to them about the stress, for those of you in the management college, the stress on banking business models. In other words, the basic question of, can you make money in banking? When you have, let us say, weak loan demand, so it's difficult to find assets, you have a cost structure, you have compliance and compliance costs, and you have pressure related to certain fees and certain things that you charge for. Can you make money with that business model? We talked about that at some length. It's, I think, a legitimate question. Not all banks have kind of totally figured it out. Monday afternoon, I received, or I was part of, a briefing on financial conditions in Europe. The financial market conditions in Europe, focusing on funding stresses of European banks, which is a central part of the European debt crisis, and really is an important focus now. And in that briefing, we talked about not only the funding pressures on banks, but also the relative health of wholesale funding markets here in the United States, and dollar funding markets abroad. The dollar being so international a currency, actually there are funding markets in Europe to fund the dollar assets, and banks have to borrow from those markets to fund their assets that are denominated in dollars. So the dollar plays a fairly important role in a zone where the currency is the euro. And also we were quite interested in how the major short-term liquidity providing funding markets here in the United States were operating. And at the moment they're operating quite well. We finally focused on, and this is relevant I think to kind of the short-term economic outlook, the potential of some kind of a shock coming from Europe and from the European debt crisis problems, as well as European financial system. And I made a talk last night in Chattanooga, and I said I think the number one risk is something coming out of this European story that spills over into the U.S. economy. So obviously that was a topic of real importance and interest. Tuesday morning, a briefing on the regional economy, the Southeast, essentially the territory that I described for you earlier. And in doing this briefing, we depend not only on data that we can follow related to the 6-state area that we have responsibility for, but we also spend a lot of time interacting with business people and other contacts throughout the Southeast. In this particular Reserve Bank, we have 5 branches. So we have Birmingham, Jacksonville, Miami, New Orleans, and Nashville. And each of those offices has a lot of contacts in their vicinity. And so we kind of pull all this together to get a sense of what's going on in the region. The picture of the Southeast, where we all live, is similar but slightly lagging the U.S. That is to say, growth levels are not quite where the total national growth numbers are, and unemployment, maybe with the exception of Louisiana, is a little worse. So if you make a generalization across the Southeast is close to the national economy, but in some measures slightly worse. Atlanta, for example, because of having so much employment in construction activity, residential construction activity, is tracking just a little bit worse than the national economy. We also got reports from contacts with a reasonable sample of businesses about their intentions to hire or to fire. Obviously a question important to some of you who are seniors, as well as important to people out there who are looking for a job. The picture we got was no immediate plans for layoffs, but also a certain reticence about hiring until essentially sales or revenues or the economy in general picks up a little further. So a sort of static picture related to employment intentions across the Southeast. Also Tuesday morning, I sat in on an internal discussion about trends in the payment system. I mentioned the payment system a couple of minutes ago to you. It's like in a way, like the back office of society. We pay little attention to it until it doesn't work, and it almost never doesn't work. In Katrina, it ceased to work, and people couldn't use ATM cards. There was no electricity. People who didn't have cash in their wallet were on their way out of the New Orleans area without money and were trying to figure out how to get cash, and they couldn't get cash through an ATM. So there are circumstances in which you could have a breakdown of the payment system, but it is generally highly reliable, and that's why we tend not to pay, not we at the Fed, but generally, collectively, we tend not to pay a lot of attention to it because it works. What's quite interesting are the trends in the payment system. I've already mentioned a couple of them. The demise of check writing. I mean, I dare say the people in this room very rarely write a check. Maybe to Georgia Tech every once in a while, but don't do it very often. The growth of electronic funds transfer with the medium of a debit card as the principal payment mechanism. The third is the just now emerging area of mobile payments, where you could use a cell phone, for example, as a substitute for your debit card, or as an instrument for access to the payment system, so that you could then instruct your bank to send money through your cell phone from X to Y. I find this stuff very interesting, and so I feel fortunate that it's an important part of my bank. So we talked about that. Then Tuesday afternoon, I headed to Chattanooga. One of my roles is to get around the Southeast and talk to audiences about the economy, to give them a sense of where the economy is and where it's going, to try to explain what the policy position of the Federal Reserve is at the moment, and to answer whatever questions, and to generally kind of engage and interact with the public so there is better understanding of policy and of the economy, the workings of the economy, a realistic sense of the future, and to some extent, by just being there and talking openly, helping to build the sense of trust that the Federal Reserve is a serious organization trying to do its best to manage monetary affairs of the country. So I went to Chattanooga, had a couple hours before I was to give a speech, so I visited an incubator in Chattanooga. So I'm sure you're familiar with the term, but an incubator is an entity, an institution, not strictly speaking a place, but in this case it was a place, where entrepreneurs start companies, startup companies. And this particular group was in downtown Chattanooga. And we spent about an hour and a half talking about issues that the Fed is concerned with, like job creation. One of the interesting opinions that we've developed from research is that a major engine of job creation in the United States is, in fact, small business, but within small business, it's new business. It's early stage businesses that often create jobs. And so business formation, which has been declining, is a very important thing to track and to try to understand. So I quizzed these young entrepreneurs sort of what gets in the way of starting a business, how do you decide to back a business, and give capital to a business, what's the thought process you go through. What I'm sort of fishing for is there anything a policymaker can advocate that would help that picture along? To some extent, entrepreneurs are entrepreneurs, because they don't want to be in the government or something, so they live in a world of just going out and doing on their own. But is there any kind of policy set that would help job creation, help us solve what really is a job crisis? A couple interesting things. Chattanooga, through a government grant, and also because of the leadership of their local utility is one of the handful of places in the world with a 1 gigabyte per second speed of internet access. So they have the fastest internet access in the country. There's some other cities that have it. We don't have it, but they have it in Chattanooga. And these young men are sponsoring what they call Gig Tank, which is where students like you with a business idea will go to Chattanooga for a summer, and you have access to this very, very fast internet if that's the basis of your product idea or if of your business idea, and essentially sit in an incubator and work on your business idea. So I thought that was a pretty neat idea, and it's interesting that Chattanooga is sort of onto this. Tuesday evening, I gave a talk to the what's called the East Tennessee Society of Certified Financial Advisors, I think, CFA Society. And I'll give you the sense of what I said. I said that year to date in 2011, the performance of the economy and the incoming measures of the economy have on balance been disappointing, at least through August. They have disappointed in terms of expectations, and they have depicted or they have shown an economy that has been weaker than we originally thought. So in many respects, up till at least August, late August, not only was the direction of many of the indicators not good or headed in a negative direction and showing a weak economy, but we were seeing disappointments relative to expectations. There's a continuous process of predicting what a particular indicator will come in as. And so many of those data elements were coming in below what the prognosticators and forecasters thought was the kind of correct path of the economy. But then I went on to say that things kind of turned in the latter part of the summer. And since then, particularly in October, for the most part, what we have seen is economic indicators that have exceeded expectations. And throughout this period, there has been growth. But earlier in the year, weaker growth than we expected. Now we appear to be on a growth path that is in the 2 to 2.5% growth of GDP range. And so I made some statements there that I did not expect a double-dip recession. I thought we would continue with this relatively modest pace of growth. And in the absence of a shock, remember the reference to Europe, in the absence of a shock coming from somewhere, that modest growth path would continue into 2012. What that means is no contraction of this economy, no recession, but it also, at that level of growth, means it's likely unemployment will come down very slowly. I also said that although inflation was higher in the first quarter than we wanted and has been a little bit more persistent and lasted longer than I expected, inflation has begun to subside, and we, at my bank, at least the Federal Reserve Bank of Atlanta, and myself as an individual, expect the inflation rate to come down into the vicinity, per various measures, that is a healthy level of inflation of around 2%. So that was the gist of the talk in Chattanooga. I quoted in that speech, and this is an important point, kind of I think an interesting one to contemplate and for you to take away. I quoted a recent Nobel Prize winner, Thomas Sargent, who 2 weeks ago was awarded half of the Nobel Prize in economics for the year. And he was quoted right afterwards saying, "What's going to happen is going to depend partly on what you think is going to happen. So the way the economy unfolds is not a sort of singular one direction cause and effect. It is your expectations influencing your decisions to spend, and then what people say about the overall direction of the economy influencing your decisions to spend, and it becomes a lot more circular. And that's why I focused on this talk on the difference between expectations and the recent data that was coming in, which has been exceeding expectations. Because I really felt, and I stated this last night, that some of the recent pessimism may have been overdone. That some of what you've been hearing about the potential for another recession may just be a little overdone, given what we see in the data. This morning I moderated a conference within the Fed on Latin America, and we had a quite distinguished panel, an investor, an emerging markets investor, and 3 academics, one from Georgia Tech, one from Harvard, and one from the University of Miami, talking about current economic conditions, outlook, as well as political conditions across Latin America. We have a sort of unofficial responsibility for interaction with Latin America in my district through Miami and Atlanta, and I'm going to Latin America in November to meet with central bankers and participate in a conference. So we have some interest and we focused on it. The picture in Latin America, interestingly, is good times because of, I'd say, 2 principal things. Commodity prices. These are commodity export-oriented economies, and that has helped a great deal in terms of the prosperity of Latin America. And secondly, they actually have been managing their economies quite responsibly. Their fiscal policy, broadly speaking, across the region is in good shape. So I started the conference saying if you live long enough, you see everything come around. And what we have now is the countries that in the southern hemisphere that used to be a problem for the advanced countries in the northern hemisphere, it's the opposite. You know, it's the advanced countries that are a problem for the relatively well-managed countries in the southern hemisphere. So that was this morning. This afternoon, just before I came here, we had our annual United Way rally. I call it my annual humiliation in front of my staff. So I put on a sumo wrestler suit with a helmet that looks like kind of a sumo headdress, and got out up in front of them, and the whole program was, instead of actually wrestling, I was to dance as a sumo wrestler. So I was sort of doing the sumo wrestler stuff, you know, like this, and throwing salt into the ring, and then I would go into a dance. What's the point of it? The point of it is part of the job is being part of a large institution, and at least once a year, putting your ego on the line because the staff has come up with something really silly for you to do, to get people to give to the United Way. I have impersonated Elvis. This year I was a sumo wrestler. That suit was really hot and hard to move around in. But it's, you know, part of the job, and you know, it's just another day's work at the Fed. And then finally, after this talk this evening, I'm headed to a dinner with David Walker. He's the former Comptroller General of the United States, effectively the Chief Accounting Officer of the federal government, and has made it really his crusade since he left that job to focus the attentions of the public on the fiscal problems of the country, meaning the deficit and debt of the country. It is not the domain of the Federal Reserve. We're monetary policy. The Congress and administration deals with fiscal policy. But I have found over recent months, at least, that because this is so central to the prospects of the economy, it's hard not to comment on the importance of fiscal rebalancing and the importance of the country essentially dealing with its fiscal problems. So I'm going to the dinner to listen to an expert, someone who's spent his professional life for several years focused on this, and to hear what he has to say and help shape my opinions, not because I'm going to talk a lot about it, but because I need to understand how big a challenge it is and how it's likely to affect the economy. So that gives you a flavor of what this kind of work is. And let me come back to something I said earlier in closing and just make something I think that's relevant to you as students who in some period of time are going to launch a career. As I said, I have a track record of following or at least experiencing trouble wherever I go. I went to Lebanon and got evacuated in the Civil War. Bullets were flying literally the morning we all left. I went to Iran and the revolution began, and I left in the middle of the revolution. I happened to be at the firm in New York on 9/11. And then I came to the Federal Reserve and I ushered in, and I hope there's no cause and effect here, the worst financial crisis in 50 years and the deepest recession since the Great Depression. There's that Chinese proverb, may you live in interesting times. Well, you know, I've been able to do that. And my piece of advice is, rather than try to avoid difficult times and really, really difficult work environments and situations, my advice is embrace it and actually seek out really, really hard jobs where the challenge is great. You know, build your own personal resilience by putting yourself in tough situations. I hope there is no cause and effect between my arrival and any of these things happening, but I've had a lot of really, really challenging experiences from being thrust into these situations. And then finally, you know, learn how to dance like a sumo wrestler. So let me end on that note. And if you have questions, I'd be happy to respond. Yes, ma'am.
Hello, I have a question. First, I have a couple questions. First is whether you have plans to visit Tehran, Iran anytime soon again.
Well, I'm not sure I'm getting your question.
First question is if you know what's the policy behind the economic sanctions against Iran?
Against Iran?
Yes.
Well, first, this is out of my field, so I don't know anything more than you know from reading the newspaper, you know, except that the relations with Iran are not good, concerned about nuclear proliferation, and consequently there are sanctions that are trying to create pressure on the Iranian regime to move from a policy point of view in a direction that, broadly speaking, not only the United States but most of the rest of the international community wants. That's what I understand about it. Yes.
So my question concerns the idea that our opinions or beliefs about the economy can impact the actual future. And if you had to choose between the two, would you rather have an initially pessimistic or optimistic belief that then got corrected the other direction?
Let me repeat the question because it's an interesting one. Of course, this is very sort of hypothetical and abstract. Would you like to start with an optimistic view that got corrected to pessimistic, or vice versa? You know, I prefer optimistic that stayed optimistic for good reason. I hesitate to provide an off-the-cuff answer because, like so many subjects in economics, somebody has actually studied this question somewhere, and I'd really want to be informed by what someone who thought deeply about it would say. let me just come back to the point that expectations regarding inflation, which we track very closely because it gives us a sense of whether inflation has the potential of getting away from us. And more broadly, expectations about the economy have a lot of influence on how it actually plays out. And what we're trying, I think, in policy to do now is to nurse this recovery until the predominant point of view is net optimistic. So people will spend, and companies will invest and hire. Another way of putting that is to take what is a sort of, I wouldn't say a negative self-reinforcing cycle at the moment, but certainly a cycle that is not terribly strong, and turn it into a true virtuous cycle. And that's a hard process to try to get that transition to happen. But that's what policy is trying to do. And the Fed is simply trying to support that process.
Thank you very much for coming. I've got a quick question on the Greek crisis and as it affects the, I guess, the Fed's role as a backstop to the ECB. Do you see any issues in the case of Greece leaving the EU and going back to the drachma in terms of solvency?
I would repeat what the leaders of Europe say, and that is not being contemplated, and that it's all in all likelihood Greece is going to stay a member of the EU. I've seen a little bit of literature on sort of some of the technical difficulty if that were to develop, meaning that temporarily or permanently Greece would leave and then essentially reissue the drachma as the national currency. It apparently would be a very complicated matter. And I think the important point, which I alluded to earlier, is maybe not so much the direct effect on Greece and the EU, but on the banking system in Europe that is exposed to Greece denominated in euros. And so that's a central question at the moment. Let me stop there. If I get too deeply into this, not my business really, so I'll stop there. Yes, Alan.
You mentioned earlier in your talk about the dual objectives that you have with the Fed, pricing and employment, and I think most of us are aware of the pricing objective, but could you explain what tools the Fed has that actually can directly impact employment in this country?
Well, it's an important question. That is, in comparison to the tools we have to try to influence price stability, what tools do we have to try to influence employment? And again, I want to emphasize what you're hearing is my personal opinion, may not be shared by others of my colleagues. I think we have a pretty good understanding of how to influence the broad price level. We have less understanding of how to influence employment or how to really affect it. And it's very important to understand that monetary policy, often called a brute instrument, we deal with the macroeconomy. It's sort of like the weather in some respects, the monetary weather. We try to create a set of conditions, cannot target on a particular industry or a particular geography. We just create the monetary weather of the country and let then the private sector and other forces, we hope, play out to the benefit of people who are looking for jobs or who are running companies or whatever. So I think it is far more difficult to target on both employment as a broad thing and then individual pockets of employment problems. Just not easily done with monetary policy.
We have time for two more questions. You had one in the back.
You mentioned earlier about there are a lot of incubators and startup, I guess, companies in Chattanooga. I was wondering what your thoughts are about any micro or macro trends here that would mimic that, I guess, digital communication sector there here, because I see a lot of medical device startup firms, and I wondered if you had any comments on that.
Let me repeat back what I didn't catch it all, but you asked about Nashville?
No, regional trends here in Atlanta.
Oh.
Similar to the ones in Chattanooga, like you were saying, a lot of the digital communications industry are attracting a lot of entrepreneurs in the tech industry. I was wondering if there are any micro or macro trend incubators here that would kind of mimic that in different sectors.
Well, there's a Georgia Tech associated incubator that I'm aware of, and I believe my facts may not be quite right, but the former provost of Georgia Tech is involved with it in some way. I remember a conversation a while back. I don't have a good census of incubators in Atlanta, but I know there are some, and obviously association with Georgia Tech is kind of an obvious leverageable asset of Atlanta. We had, I'm going to shift a little bit and not exactly answer your question about Atlanta per se, but we had in the bank here in Atlanta a few weeks ago, 6 or 8 incubator managers from across the country. And I found it to be a very interesting session. I thought of incubators as a place where you go and get some space in which to start your company. But really what they described is it's more increasingly a kind of virtual association that galvanizes investor networks. They're called angel networks, to provide capital to promising startups, and pulls together a group of people that look at business plans or business concepts and either accepts or rejects or tells the entrepreneur, you got to change this or this doesn't make sense. So one of the incubator managers quite literally said, we are virtual. We borrow office space until someone kicks us out, and then we go somewhere else where they have excess office space, a law firm or whatever, and we keep moving around. This was in Colorado Springs, because our real job is to help the entrepreneur raise the capital and get good feedback on the business plan, not provide a place. So I found that quite interesting. There are a lot of different variations on that theme and different levels of success, but it is one of the ways we cultivate small business startups in the country. And that's very important, ultimately, as I said, to employment.
I think I have the last one.
You get the last word here, or I get the last word,
You get the last
word.
I was intrigued by the way you began the conversation about deficits. And I wonder how you break down the deficit, because a deficit isn't a deficit isn't a deficit. And what I'm thinking is of deficit that is the result of investment in technology, in innovation, in science, in education. That seems to be going the same way as the investment that could be related to our hearts, the kinds of deficit that comes from, increased security by locking so many people in prisons, which, doesn't create value. So do you at the Fed look at different kinds of deficit contributions, and do you separate those in terms of policy?
Well, first, your point is well taken. I do want to emphasize that our responsibilities relate to monetary policy, so we don't devote a lot of resources to analysis of the federal deficit or state and local deficits. We do have a unit we have a unit here in Atlanta of a few economists working with our Cleveland bank that are focusing on state and local fiscal issues as a potential systemic risk or systemic question. So they're studying not individual states or municipalities, because it's hard to imagine that one going bad is going to somehow create an event that hurts the economy broadly, but the whole swath of state and local government and the pressures they're under, to what extent is that fiscal or a systemic concern. And added to that, because it's part of the true economic deficit that some state and municipalities have, is the question of pensions and pension obligations and what those look like. So when you paint the total picture, it's not only budget spending, but the essentially projection of pension obligations into the future and what that looks like relative to the revenue generating capability of that particular entity. You make a valid point, I think, and it's a very general point. I happen to agree with it. This is not a highly studied point of view. I think your point is good, and that is, deficit spending, in my opinion, isn't in and of itself a sin. It's a question of its relationship or its ratio to the revenue generating capability of the government entity, and in the case of the federal government, to the whole economy. So many of those ratios are debt to GDP, deficit to GDP, and so forth. So it's not in and of itself necessarily a bad thing, but it's what you're spending it on. And if you're spending it on investment goods that are going to strengthen the economy for the long term, I think that's a far different matter than effectively, whether it's at a household level, a municipal level, a state level, or federal level, spending it on consumption, current consumption. So I think that's a valid distinction to be made. We don't study that in great depth because it's really just not our business. Thank you all. I've enjoyed it. Good to be here. Thank you.